Welcome to the Swell Investor Series. As we reflect on June and July, and we think about the long and the short term, we really wanted to give you an update and let you know where our head's at the moment. We understand there's exceptional volatility, and our job as investors is to take advantage of that volatility. And the good news is, as share prices fall, the valuation discount increases, and we're seeing that happen today. Now, Alex, I know we've talked a little bit about this. How are you seeing things at the moment?
Yeah, so when we look at the companies in our portfolio, we've never seen more opportunities than we currently have at the moment. So if I think back to the last 5 years, some of these valuations, it's been hard to see buying opportunities, but now nothing fundamental has really changed with a lot of these companies. Yeah, the share price has dropped, especially the tech stocks.
Yeah.
And I mean, some of the tech stocks we own, well, all the tech stocks we own, we believe are very high quality tech stocks. And you could put tech stocks into two categories, the lower quality ones and the higher quality ones. And quality being just such a fundamental part of our process, we've always wanted to own these high quality stocks. So as the share prices have come down, we've been adding more to them.
Yeah, absolutely. That's a really good point. I think the volatility has really been across all technology stocks, but the ones that I believe deserving of falling down have, but they've brought down the great stocks as well, the blue chip technology stocks, and that's the Amazons, the Facebooks, the Microsofts. These are businesses that have net cash positions which are able to invest throughout the cycle, and you're seeing that now with Amazon. They're continuing to invest. They added 4,000 people in the UK just this week, and overnight just made a large acquisition. So these businesses are certainly not shying away from the growth and are going to deploy the capital. And we see this as a big opportunity over the long run.
Yeah, and as you mentioned, Amazon, when we look at the valuation for Amazon, we see there's really three businesses there. There's AWS, which is the cloud business. There's the retail business, which everyone is well aware of, Amazon.com. And then there's the advertising business. And we think when we look out 3 to 5 years, the Amazon Web Services, the cloud business alone, is worth about $1 trillion. Now, Amazon's current market cap is about $1 trillion. So you're essentially getting the retail business and the advertising business, which are both huge, high quality businesses in their own respect, for essentially nothing.
That's right. Yeah, I think that's one of the things we'd like to call out today is that, look, there is incredible opportunity, and Amazon speaks to the opportunity that's out there. The cloud is exposed to very long-term structural tailwinds. Companies are migrating their workloads to the cloud. Around 10% of the workloads currently are in the cloud. So this has a decade still to run. And in retail, probably worth touching on e-commerce, Alex. It's one that we've been looking at very closely.
Yeah, e-commerce is another one which has just a tremendous long-term opportunity. And I know the market at the moment is just focused on the next 6 months. And when you look at the next 6 months, obviously there's a whole bunch of macro headwinds that everyone's seeing, but nobody's really looking at 3 years plus, which is where we are. And at the moment in the US, I think e-commerce is about 15% of total retail spend. When we look at millennials and the Gen Zs, they're spending 50% plus of their income online. So naturally, as they grow as a portion of the population, they're going to be pushing e-commerce. So it's not too hard to see e-commerce as a percentage of retail doubling or tripling over the next 5-10 years and into the future.
Absolutely. What we're seeing in the market at the moment is really an obsessive focus on inflation. And look, inflation is rising, so it is a problem. But if we look at the consumer in the US, the consumer is in very good shape. Now, despite the fact that consumers are in good shape, they're feeling concerned about the future because they're seeing food prices and oil prices rise rapidly. But if we look at the input costs, we're seeing them all start to roll over. So we expect inflation to come back from the levels it's at today. And as that comes back, you'll see the consumer get a little bit more constructive on the outlook. But as much as we don't like to see uncertainty, this is opportunity. As an investor, uncertainty provides opportunity, and that's what we're seeing today in the market. And Alex, a big part of our process is stress testing our models, and perhaps you can talk about some of the work we've done stress testing our investments.
Yeah, sure. So when things sort of go awry, then we always come back to the process. And a part of our process is stress testing. So that means we essentially have our valuation model and we put in like worst case assumptions in there and see what the valuations come out as. And when we're going back to our models now, we can put in some very dire assumptions and the valuations still stack up for all of our companies in the portfolio. And so that leads us to believe or have confidence that the bad news is already factored into the price for a lot of these companies. And so that's why we're essentially fully invested.
Yeah, that's a really good point, because expectations drive share prices, and the expectations at the moment are that we're entering a very, very bad recession, and we don't think we are. The investment cycle, the business cycle, has really been compressed into 2 years now. So we're going through, I guess, what is potentially a recession. We'll find out next quarter if we're in one already. But given the health of the consumer, we see any recession being very, very short. And recessions can be good for companies that have strong balance sheets and are willing to keep investing. So, Alex, do you want to talk a little bit about the expectations and how we're seeing the market at the moment?
Yeah, so it's a question we get asked a lot: is are we at the bottom? Should we be investing now? And the reality is we don't know if we're at the bottom. But for us, as value investors, it really doesn't matter that much. I mean, we know we're much closer to the bottom than we are to the top. And when we look at valuations for all of our companies, we know that they are good value now where they are relative to their price. So yeah, it's a good time to be buying them.
That's right. I mean, if something's trading at 0.3 of its value, then we feel very comfortable investing at that price. It might go to 0.25x, but it's not going to go a lot lower. So we expect if something's worth $100, that it will get back there over time, and we take advantage of these pullbacks in prices. Thanks for joining us for the first of the video series. As we look back over the last few months, it's been a very tough time, but as we look forward, we see things improving, and we look forward to bringing you our next update next month.